From New York City for our viewers worldwide, I'm Dani Burger in for Jonathan Ferro. A surprisingly calm market over the past 24 hours after that CPI surprise on Tuesday. Bonds are bid, stock futures are bid with the help of weaker retail sales data. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Coming up, U.S. retail sales dropped by the most in nearly a year, raising questions about the health of the consumer and reigniting the Fed rate cuts, the case for it this year. We begin with the big issue. Is the consumer starting to crack?
I wouldn't necessarily read so much into this weaker retail sales report. We have had a string of 6-7 months where we've been surprising to the upside. The consumer has been very strong, and maybe there's those seasonal adjustment issues. But we are watching for signs that things are starting to slow down, and maybe this is the early indication of that.
Let's get right into the results. Joining us is Bloomberg's Mike McKee. Mike, it comes in at a negative 0.8%, more than expected.
Definitely. We were expecting a 0.2 decline on the month. Instead, we get an 0.8 decline, and we get December revised down a little. Now, there's going to be a lot of talk about it being a weather-related event and also perhaps some payback for what we saw during the month of December. Fairly strong numbers, but it's still not great news for the economy overall. Retail control sales in particular were down 0.4% after an 0.8 gain the month before. Retail control is what goes into GDP. There was good news on the jobless claims front. 212,000 down 8,000 suggests companies may not be reacting to a slowdown in the economy. But then there's also some bad news in the price numbers that we got. Import prices up 0.8. That's the first increase since early last year, and it's the strongest increase since 2022. On a year-over-year basis, import prices are still down 1.3%. But they were down 2.4%. So some inflation pressure coming in from overseas. And this is not just oil, it's goods as well. Philadelphia Fed, while the headline improved, the prices paid number got worse. Not tremendously, but a little bit worse. And Empire Manufacturing gets a little bit better as well, but still prices paid an issue there. Retail sales, for the most part, are at this point a disappointment, as you can see with the blue and the white lines down there. The question is, what does it do to that yellow line? That's the Atlanta Fed's GDP Now number, and of course, it's just based on January data for the most part, but it should be pulled down significantly. We'll get an update on that later today, and it does look like the first quarter, based on consumer spending, since it's such a big part of the economy, the first quarter is going to be much slower, perhaps, than the fourth quarter and certainly the third quarter. And then finally, you want to take a look at what is going on with overall jobs and prices. And at this point, what we're seeing is the import prices and the Philadelphia Fed prices rising. And so, unfortunately, this is going to raise questions at the Fed. The issue is, if the economy is slowing, does that mean that these prices will fall back and we're not going to have to worry about it? That's the debate over the next couple months to come, Dani.
Mike, it certainly feels like choose your own adventure data. You can make basically whatever narrative you want out of that. Mike, thanks so much. Michael McKee there breaking down the numbers. Let's continue the conversation. Joining us now is JP Morgan's Jay Barry and John Hancock's Matt Miskin. Matt, let me start with you. We had weaker retail sales data, 0.8% decline. Estimate was 0.2. You matched that with CPI on Tuesday. That came in hot. How are we supposed to be data dependent when the data is sending such mixed signals?
Yeah, as you say, Dani, we got to choose our own adventure here, right? But at the end of the day, think about retail sales. That's nominal. So that high inflation is embedded in it actually is helping the retail sales number. You strip that out and you think about the real retail sales, that's not great. We think actually end of last year, consumers really went on credit and levered up a bit to have good holiday shopping on the midst of a good stock market. But the cost of capital is still very elevated and mortgage rates have ticked back up. We're seeing mortgage demand slip again. And we think the Fed is going to be pushing back on this economy after a really good run in the last several months. We think that it's going to decelerate here. And equities are frothy in parts, and there's some bubble-like tendencies we're seeing in markets. We would trim that here and redeploy into higher quality parts of the market.
Jay, would you agree with that? It's a consumer that's cracking, a decelerating economy that the Fed's going to have to push back on?
Morning, Danny. I would sort of push back a tiny bit. We don't think the consumer is cracking, but merely normalizing here. But we do agree that growth is slowing, and I think after strongly above trend growth at the end of last year, amid all the volatility that we've seen in the data flow the last few weeks, it does indicate to us that consumption is probably normalizing closer to a 2% pace in the first quarter. So if that's the case, it means that we're downshifting, we think, towards below trend growth, but not necessarily cracking from right here. And if anything, that is supportive of a Fed that will begin easing at some point later this year. We continue to look for the Fed to start easing in June, and certainly the market's expectations have been pushed back over the last couple of weeks, but we think this is reflective of that sort of outcome.
Yeah, you're not the only one. Barclays and BNP both writing that they're shifting their outlook to June to be the date that rate cuts start to happen. But we can't forget that hot CPI data. At least that's what Mohamed El-Arian says. I want to bring you draw both of your attention to what he wrote in Bloomberg Opinion, saying that it's a wake-up call. Resist the temptation to dismiss the market and media narrative reaction as a storm in a teacup. Instead, we should see the reactions as a wake-up call for traders, investors, and economists. In other words, we might not be so quick to cut, and to be so quick to cut forcefully. Matt, do you think it's a mistake for markets to brush this off and continue to buy like that CPI data didn't happen?
The thing with the CPI report is 70% of it was shelter and housing and rents. And if you look at the Zillow data or you look at the rent.com data, it is showing much lower inflation than what the Bureau of Labor Statistics is putting out. And what we're likely to see is the shelter component is going to decelerate here over the next several months. I don't think that report was the end of the world. It's basically 1/10% over estimates. And again, it was all shelter. So if you strip that out, and I know we don't like stripping out CPI components. I know that's a negative, but if shelter's 70% and that's a lag data point, maybe it's not as bad as we fear. But I think regardless, the animal spirits that we're seeing in the economy and the markets, the Fed can't really take the foot off the brake yet. And I think they're going to be on hold until some liquidity event happens, something cracks in the labor market. It's not there yet, but that's what's hard about positioning in bonds. You need to be patient here because when that turns, it's going to be hard to put the bond allocation on. If it turns fast, you got to sit, wait. We're getting paid nice income, and just wait until that turns because you're going to see rates likely drop. And if you're not there yet, it could be a tough point to get there quick enough.
Matt, I'll forgive you for stripping out housing because I feel like weirder things have happened. CPI minus shampoo and dog food or something like that. So, Jay, given the reaction to CPI that we've seen, do you think it's wise to be buying bonds on those types of sell-offs?
Yeah, so first, I don't think that the bond market dismissed the CPI report, Danny. That was a very big reaction that we had earlier this week on Tuesday to the CPI data. And still the market's expectations of when the Fed begins easing have moved back from where they were just a few weeks ago. But from our perspective, I do agree with some of what Matt has said here. A piece of the outperformance was definitely OER. It diverged from the rental data, and we don't think that should continue over the longer term. And even the chair's super core category did seem to surprise at the upside due to some idiosyncratic reasons. But at the same time, we just don't think that the path toward lower inflation will be as one way as it has been for the past 6 months. But either way, we're in between the end of the Fed tightening cycle, and we think just a few months away from when the Fed begins easing. And when it does start easing, it's going to move policy rates significantly less restrictive than they are right now. So that's the sort of period that's been very supportive of being long fixed income, whether it's a very shallow easing cycle like we saw in 1995 or even 2019, much less a full-blown easing cycle like 2001 or 2007-8. So from our perspective, this is the time when you're supposed to be overweight duration as you head into a Fed easing period. But you also need to be very careful because I think what Matt said is important here. Investors have been positioned for rates to fall. And when positioning really gets aggressively long relative to where it's been over the past year, it can really sow the own seeds of its own destruction. And I think we've seen some of that over the last couple of weeks because both active bond fund managers and hedge funds were very long heading into the data the last few weeks. It seems to us that it's pretty much more neutral right now, but we're cognizant of that dynamic as well.
That's the positioning on the bond side of things. Matt, do you worry about positioning on the stock side of things? If we're saying that, okay, yields did have a big reaction, stocks reaction down 1 1/3. We basically have already undone that with yesterday's move of 1%. Are we overstretched in this equity market, Matt?
Yes. As simple as that. Keep it simple, right? I would totally say we are. And really what we're seeing is a lot of systematic, algorithmic trading, more trend following type strategies are dominating this market. You can see the fingerprints of it all over the place. And one of the things that we struggle with is now those are all in, max long kind of type positioning, and that can turn fast. And they're bidding up things that don't necessarily have a lot of intrinsic value. Some of them, some of the AI stuff does have growth. I get it. But when you're talking about 10% a day type moves, or we're already, into the second month and a half into the year, and we're talking about 50% moves on certain stocks, we think they're going to have to take a breather and likely have to have some corrective price action. So we are looking at cheaper parts of the market. We are looking at less momentum-driven parts of the market. It's difficult for fundamental investors right now because it's so momentum-driven, but we would trim into the momentum factor and find other parts of the world or the markets to deploy that capital.
Right. You'd be surprised that there are other parts of this market right now, Matt, given every day all we're talking about is NVIDIA making new highs. Jay, it's not just a frenzy around AI. This corporate bond market has had a frenzy around it. The demand is insatiable. Yields are quite compressed. Spreads are really compressed. You have companies coming into market even after all of that CPI. Does that say something about fixed income demand? Should the bears be looking in that and say people want paper, people want income? There is still strong demand in this market.
I think it absolutely does, Dani. I think credit spreads are sitting very close to their tightest levels of the cycle. But more broadly, against the backdrop of what's been very strong issuance this year, this reflects very underlying strong demand for fixed income. And even though yields are considerably off the peak we saw late last year, they're still close to the highest levels we've seen in 15, 16 years. And fixed income more broadly is a very viable investment alternative for the first time since then. And while our outlook on credit spreads from my colleagues in credit research is that there's some near-term risk of widening and that you're unlikely to get further spread compression, the supply dynamics, the demand dynamics are all very favorable, and you're likely to earn, as Matt talked about before, pretty strong income in credit and in fixed income overall this year. So I think this is emblematic of that demand without a doubt.
Jay, Matt, stick with us. We have a lot more to discuss. That's Jay Berry and Matt Miskin. Now, let's get a look at some of the stocks that are moving ahead of the opening bell. With that is Abigail Doolittle.
Well, Dani, we do have some of the crypto stocks moving higher. In particular, Coinbase, that crypto exchange, it is up pretty nicely at this point with Bitcoin, but also the expectation of a return to profitability when they report tonight, up 4.6%. AppLovin up in a huge way, up 21%. Now, there is a 10% short interest here, so it could be a squeeze, but they did beat adjusted earnings in a big way. They beat sales. The mobile app marketing company, our analysts are upbeat on it, so that is a big winner at this point here in the pre-market. To the downside, though, Twilio down 11.6%. The software company put up a big beat, but the current quarter revenue is surprisingly light. It is up about 70% from last fall, so investors wanted perfection. They simply didn't get it, Dani.
Abigail, thank you very much. Investors demanding a lot this earnings season. Now, coming up, speaking of which, Cisco is joining the growing list of tech companies that are cutting jobs.
Cisco's the backbone of the internet, as you know, and their routers, network, server, business, these things, their switches are truly important to bringing in cash flow, but the future is in services.
We take a look at results from the world's largest network equipment maker and how it may impact NVIDIA's earnings next week. This is Bloomberg.
We look at the free cash flow, we look at the strategy. I want to point out a very underpriced component is the capability they have in these AI collaborations. They're expecting about $1 billion in revenue. It's a small amount of revenue relative to the whole size of the company. There's huge upside to some of those collaborations with NVIDIA, with AMD, with Intel, some of the major players.
The Bahnsen Group making the bull case for Cisco following disappointing results. The company slashed its outlook, announced plans as well to eliminate roughly 4,000 jobs. CEO Chuck Robbins saying this, quote, "We're seeing a greater degree of caution and scrutiny of deals given the high level of uncertainty, making us more cautious with our own forecast." Not a great omen for the market's biggest darling, NVIDIA, whose monster rally will be tested next week when it reports its own earnings. Joining us now is Bloomberg's Mandeep Singh and Ed Ludlow. Ed, let's start with you on Cisco. 4,000 of job cuts. It's yet again another tech company and another round of layoffs.
Yeah, and a big picture macro concern. So 4,000 jobs is about 5% of the 85,000 employees Cisco has. I think, honestly, what's got the street worried is the revision to their full year sales outlook. So they're saying now that sales would be $51.5 to $52.5 billion. They'd previously guided to $53.8 to $55 billion. So it's a significant revision for the full year. And in the fiscal third, it kind of manifests itself in the short term as well, saying revenue of 12.1 to 12.3. They had seen more than 13 billion. It was an interesting clip you just played. I mean, you have to differentiate the investment that is going on in infrastructure. In other words, the hyperscalers who are building out data center with high-performance GPUs or AI accelerators that go into it. Those things do need Ethernet and other server design components, but Cisco's mainstay is networking. And a lot of emphasis gets put on the collaboration with NVIDIA to try and tap this broader market for AI. But Cisco's kind of target audience is the SME. It's not the hyperscalers where a lot of the money's going right now. You see names like Supermicro, for example, on an absolute tear because their business is more directly relevant to the build out of that data center infrastructure than Cisco. And at the same time, Cisco's trying to be a software name too. So it's a difficult position they're in, but they are vulnerable to the macro picture because of the scale or spectrum that they have within the size of their customer base.
I mean, Supermicro up some 200% this year. Truly bananas. Mandeep, then does NVIDIA fit in the category of not being susceptible to the macro picture like that of Cisco? Can anything stop this stock as it takes over Amazon in terms of market cap?
I mean, the stock versus fundamentals probably are different at this time. I think there is a lot of excitement around how far the stock can run, and that's reflected in the valuation. But look, it's well supported by fundamentals, and there are very few times when you see, a company actually putting out great numbers quarter after quarter, and it could very well be the case this quarter too, because look, the demand is insatiable when it comes to their GPUs, and you know how the dollars are flowing. It's from the capex of hyperscalers that Ed was alluding to, and there just seems to be, quarter after quarter where they have the pricing power. It shows up in their margins, and I wouldn't be surprised if they do something similar here. But again, look, valuations are rich at this point of time, and can they do it, for the next 5 years? I think time will tell, but the demand visibility is there for NVIDIA.
As an investor told me today, the routine is to wake up and check NVIDIA's price. That's all you need to do if you're a stock investor, apparently. Mandeep Singh and Ed Ludlow, thanks so much for that wrap up on tech. Now, John Hancock's Matt Miskin is turning away from some of these AI names, writing, "We would look to trim small caps, crypto-related stocks, even AI darlings, the momentum factor, etc., after recent strength, and focus on the quality factor." Matt and Jay Barry are back with us now. Matt, you had mentioned this before the break, this idea if you want to trim back on some AI. But if you look at NVIDIA's gains, you look at Supermicro, 200% gain. Can you really afford to miss out on that?
I think the way you put it is a great sentiment indicator. Truly bananas, Dani, was the way to put it. And I like that. I get it. Like, they are going up. I agree with the analyst just said that, the fundamentals are pretty good. There is growth. I see that. The margins are good, but it's in the price. And look, it's been a tremendous run. You look at the revenues relative to Amazon, I mean, they're not even close. And to say that the stock is worth that much, I think you got to build on. You've already had huge growth, and now you got to do that again on top of that. I think that's really hard. Right now we look at this part of the market as there's better quality. We're trying to do quality at a reasonable price. That is kind of our mantra right now within the equity market. And unfortunately, they are quality, but no longer a reasonable price to us.
Yeah, fair enough. I was going to say the momentum factor and quality factor do seem to be more closely tied than they ever have been. Jay, if you think about Cisco cutting 4,000 jobs, you think about tech as a whole, I think the tally last week was 32,000 job cuts planned for 2024. And then I go back to the jobless claims we got this morning. It's not showing up on the macro level. If you look at tech, is it idiosyncratic, or do you expect some of these cracks to broaden out?
So, Dani, we are not looking for cracks, but generally speaking, a significant slowing in demand for labor and hiring. And I think you're right. Jobless claims, they're the best momentum indicator that we have for the U.S. economy and still indicate that separations are pretty low and that the labor market's very healthy. But I think if we decompose the growth of the labor market the last few years into changes in unemployment, changes in participation, and changes in labor supply, the unemployment rate's obviously fallen back to multi-decade lows. Participation rates are back kind of at their best levels of this century. And immigration and labor supply is probably set to slow once again. So if that's the case against the backdrop of what we seem to be seeing is a full rebalancing back towards services in the last few years, it indicates to us that jobs are slowing, but not probably completely cracking. And again, I think this is why we are in the soft landing camp looking for sub-trend growth, but not necessarily a deep recession, because it's hard to identify really where a nonlinearity comes from in this respect.
Jay, Matt, really appreciate your time this morning. Great to get your thoughts. We're going to have to leave it there. That's Matt Miskin and Jay Barry. Coming up, your morning calls, and later from big tech to the small caps. RBC's Amy Wu Silverman joins us at the opening bell. We're going to get her outlook on this equity market as the gains, they keep coming. That conversation shortly to come. This is Bloomberg. Get you your morning call as a look at some of the analyst recommendations on Wall Street this morning. First up, Morgan Stanley downgrades U.S. steel to equal weight, seeing limited upside due to softening demand and weakening steel prices. Next up, Redbird Atlantic downgrading Comcast to neutral. They expect more downside to cable broadband subscription estimates. Finally, J.P. Morgan, an upgrade to Coinbase. They go to neutral, pointing to the monster rally in Bitcoin prices this past month. It's a rally for risk everywhere. U.S. equities above 5,000 again for the S&P. Can it stay above there? How many more gains do we get after a weaker than expected retail sales data? Coming up, we're going to speak with RBC's Amy Wu Silverman. She'll unveil her outlook for the AI darlings. NVIDIA gearing up for earnings next week. We'll have that conversation coming up next here on Bloomberg. Equity markets running out of steam as we head into this open. It had been a Teflon market, a gain of more than 1% yesterday. We initially got fuel thanks to that weaker than expected retail sales data, but it isn't a still strong jobs market that is limiting us from the most of the gains. You're also seeing small caps. Those are outperforming, up 0.7%. The Russell 2000 has gotten beaten up. Perhaps it's finally time for revival. Meanwhile, looking at your cross-asset picture, we are seeing a bid come into this bond market. Not huge, but we are seeing yields go lower by 0.4%, aided by a recession in the UK that saw yields bid off the back of that. Your euro dollar, that's also a little change. We're at 107.69 this morning. Euro had also gotten beaten up after that CPI report. Crude, meanwhile, little change to slightly higher, up 0.3%. The IEA says the same old thing we've always heard, that demand is slowing, but supply in non-OPEC plus countries is rising. So that's your look as we head into the open. As we're in the open now, and of course, one stock to watch at this open is Cisco. Shares are under pressure. They delivered a disappointing outlook, along with plans to cut thousands of jobs. Bloomberg's Ed Ludlow has more from San Francisco. Ed.
Yeah, good morning, Dani. We are down 4% as we were in pre-market. That puts Cisco on track for its biggest drop since November and trading at its lowest level since the first week of December. The job cuts is the headline, right? So 5% of an 85,000 person workforce is about 4,000 jobs. But the street is very fixated on the revision to its full-year sales guide. Full-year sales will now be $51.5 to $52.5 billion. Previously, Cisco had said $53.8 to $55 billion. So it's a significant revision. And earlier in the program, we talked about what's happening. Cisco's not yet tangibly seeing the feel-good effect from all of the dollars spent on AI infrastructure being the optimal word. Cisco is the leader in networking, with a much wider range of customers, from very small businesses to some large enterprise customers. They have that recently announced partnership with NVIDIA to try and make AI technology more accessible to businesses of a smaller size. But right now, the focus is the hyperscalers. AWS, Microsoft Azure, Google Cloud Platform, the build out that they're doing in data center. And if you look at the sell side analysis, the macro environment is making Cisco's core customer base more cautious, but they're also just only seeing kind of incremental narrative around AI. So the stock now actually paring a lot of those declines down 2%. Even so, clearly not the momentum that Cisco wanted going into the year.
Nope, you need to be, as you say, one of those hyperscalers or the picks and shovels. Ed, thank you so much. Let's stick with earnings. Deere has slashed its annual profit thanks to lower crop prices and slumping demand for equipment. Abigail Doolittle has more. Abby.
Indeed, Danny, and that is why the stock is down nearly 5%, heading to its worst day since August of last year. Now, first looking back, the quarter that they just reported, it was actually very strong. They beat earnings and sales. They sold more tractors than expected. But falling prices really didn't flow through. As for the full year being cut, it's exactly what you're talking about. Farmers, the demand is a little bit less relative to income weakening for agriculture. Plus, the crop prices falling. We have a lot of, I would say, deep bear markets for some of the grains, such as corn and wheat, not helping out either. As for analysts, they're relatively supportive. I would say neutral to saying it's a solid quarter, just some missteps here. Investors, though, less so. Since the peak, the all-time high last year, Danny, this stock is now nearly in a bear market, down about 19%.
So close, Abby. Thank you very much. Now let's turn to the media space. Shares of Paramount are moving lower on news that Warren Buffett's Berkshire Hathaway reduced its stake in the company. Simone Foxman has more. Simone, what Buffett buys, we all buy. What he sells, we all sell.
Yeah, and selling here about 30 million shares, reducing its stake by a third. Still owns about 63 million shares. Remember, all of these numbers coming at the end of the fourth quarter. So now owns about a 10.4% stake in the company, down from around 15%. This is a stake Berkshire's held since the first quarter of 2022, has been the largest holder of those Class B shares. Bloomberg Intelligence says this move may signal that Berkshire's simply running out of patience with Paramount Global. It's been the center of a flurry of M&A talks, but is still controlled by National Amusements and Shari Redstone. Meanwhile, the fundamentals continuing to deteriorate, as something BI points out. $3.5 billion in losses on its streaming business in the past 2 years. This may also say something about the outlook of those merger talks. Remember, Byron Trott, who is sort of known as the Berkshire whisperer, has been reported to be involved in helping Redstone potentially dispose of all or parts of Paramount and maybe even National Amusements. This really taking a toll on the bullishness we saw earlier this week. We ultimately get a consensus on where the company is going maybe on February 28th when we get earnings, but at the moment, shares now down to their lowest since about November.
Simone, really appreciate it. Simone Foxman there on Paramount. Now, those are the moves underneath the surface. Your S&P 500 just opening now up 0.2%. And I've got some good news for you. If you went out and bought one of those caps that say S&P 5000 on it, it might have dipped below it on Tuesday after the CPI, but we have bounced back, almost like it never happened. That sell-off was met with a 1.3% gain. We're back at 5K. It is a Teflon market that feels like it doesn't care about hotter inflation data. Let's now get to Amy Wu Silverman, Managing Director and Equity Derivatives Strategist at RBC Capital Markets. Amy, what do you make of the resiliency of this market?
Yeah, there's been shocking resiliency. And when you look to the options market, when you look to what the sentiment is telling you, especially in mega cap tech, it is overwhelmingly exuberant to the point where, we could really call it historic in names such as NVIDIA, for instance, which has yet to report, but will next week. We're looking at levels that we last saw in May of last year when you recall the stock reported up 24%.
I looked at NVIDIA one-day implied earnings move, some 11%. ARM, to your point, huge demand in calls. Record after record is being set for volume traded. Translate the Greeks for us, the gammas, the deltas. What does it mean practically to have such a large bullish options buildup behind these AI and software names?
I think the single most important takeaway an investor can get from this is that when stocks trade on this momentum and gamma-driven factor, it tends to get more momentum to the positive side. So it's interesting because if you ask me what the options market is paying you to do right now, it's really paying you to sell those calls. They're historically expensive, skew is inverted. But when you look at what happens in the past, when you get these levels of exuberance, it typically triggers more upside. And that's what people are really afraid of. I would tell you that, frankly, investors are very afraid of that right tail right now. We've really repriced the whole options market. People are much more worried about that upside gap currently than they are about that downside gap.
There also does have that FOMO kind of factor come back into this market. You look at just what the sell side is doing. Over the past few days, UBS, Mizuho, Morgan Stanley, Bank of America, Goldman all hiked their year-end targets for NVIDIA, trying to keep up. Amy, is there a sense that if you've missed out at this point that you're just too late, if that tail risk is so alive and present with us right now?
Yeah, I would tell you what the options market is telling you is that there is still that fear of missing out, which is why we see that call wing bid so much. It's interesting because I have to imagine there are folks who are already long NVIDIA, already long the mega cap tech, and are they hedging the downside? They've obviously had a lot of great gains. The simple answer is no. You don't see this on the downside at all. So, folks who are long are not worried about downside, and folks who are not long enough are really worried about not getting enough of that upside.
That is so incredible that the fear is more upside. The fear is not downside right now. Amy, we were speaking with Matt Miskin earlier in the program, who said, I don't want momentum anymore, that factor. I don't trust it. I want quality. Amy, though, are the two tied right now? Because you think of the big tech names that are gaining, they're companies with really large cash piles at the moment. Are quality and momentum to some degree the same right now?
So I think that's a really, really interesting observation. And I would tell you that I probably tend to agree with that. We've been tracking that through our two baskets, our high quality basket and our low quality basket. And when you look at what's in that high quality basket, what has positive free cash flow, what has positive net income, it's the great balance sheet mega cap tech names. It's your same crew of Mag 7. And what else is really interesting is, you simply have gotten a flight to safety bid. It used to be your flight to safety bid in a 60-40 portfolio was to go to bonds. Well, unfortunately, that correlation has proved to not be very welcoming in recent years. And there's almost been a flight to safety bid inverse correlation between tech and everything else in the market, which is why you get that Mag 7 and everything else effect.
The other side of that is small caps, which have just been beat up last year. We thought they'd do better this year, but it happens again. They are outperforming. The futures are up 1 1/3%. Amy, you write that your clients are asking when the small cap trade reignites, when breadth widens. I want to know the same. What have you been telling them?
So, we started this kind of brief romance in November where we really saw that breadth widening out, and then that kind of got all sucked away at the beginning of this year. I think for us to turn to that widening breadth argument, you're going to have to see that exuberance and skew in those mega cap names start to wane, because I do think there is sort of a zero-sum situation going right now because the flight to safety really is mega cap tech. If we start to see that wane and we start to see that exuberance go back to the small caps, to IWM as a proxy, for instance, that to me is telling me the market is finally ready for breadth. It wants to be ready for breadth, but you don't actually see it in the options market yet.
I'm ready for breadth, Amy. I'm ready to talk about something different than the Mag 7, let me tell you. Amy, stick around with us. That's Amy Wu Silverman. Now, coming up, House leaders are set to gather for talks with top U.S. intelligence.
Last month, I sent a letter to the White House requesting a meeting with the president to discuss a serious national security issue that is classified. I will press the administration to take appropriate action.
We'll have the details on the potential threat from Russia next. This is Bloomberg.
And I'm not in a position to say anything further from this podium at this time, other than to make the broad point that this administration has gone further and in more creative, more strategic ways dealt with the declassification of intelligence in the national interest of the United States than any administration in history. But in the meantime, the most important thing is we have the opportunity to sit in a classified setting and have the kind of conversation with the House intelligence leadership that I, in fact, had scheduled before Congressman Turner went out today.
National Security Advisor Jake Sullivan speaking yesterday about a threat to the U.S. identified by U.S. intelligence. Since that threat has been revealed, Russia molds a nuclear weapon in space, although no weapon has yet been deployed. Sullivan will meet with top congressional leaders today to discuss that issue. Now, it also comes as Donald Trump molds plans to push Ukraine to negotiate an end to the war if he returns to the Oval Office, as well as considering scaled-back commitments to some NATO members. Bloomberg's Anne-Marie Hordern has been following it all for us. Anne-Marie, how much of a break would this be, of a fracture would this be within NATO if Trump tries to push something like a two-tiered system ahead?
Well, one thing we should note is that these are just ideas that the campaign seems to be discussing and that we were able to get a little bit more insight on. We do know that Trump, for years, has been talking about NATO and wanting allies to reach this 2% target. Obviously, this has become front and center, where he had during a campaign event talk about the fact that when a country stood up and said, "Would you come to our rescue?" He said, "Well, if you didn't hit your 2%, he would say he'd allow Russia to do whatever he want." For some, this was almost going over a red line. You heard from someone who's worked with him in the past, talking about the fact that this is just tough love. But what they would seem to be doing, this two-tiered response, would be that those that did hit their 2% target, their own defense to their own country, to their own defense money, that they would be viable under NATO under Article 5. And then those that didn't potentially would not. Or maybe what the administration would do is a tariff approach, maybe like a carrot and stick approach to try to get more of these NATO members to hit 2%. But we should note, these are just ideas within a campaign, and nothing has changed the U.S. force posture with NATO at the moment.
I got to be honest, Anne-Marie, before I went to sleep last night, I saw that ABC story saying that Russia's plans and their threat involve nuclear weapons in space, and then I prompted to not be able to sleep last night. What do we actually know about this?
Well, this caused a lot of confusion because you had a top GOP lawmaker coming out yesterday and saying that the president should declassify some of this information. What we do know is that Jake Sullivan, the president's national security advisor, will be meeting with top Republican and Democratic lawmakers, the Gang of Eight, as they're known, in Washington, D.C. today to discuss this intelligence. And what we do know is that Russia is discussing the possibility of basing a nuclear weapon in space. Is it an immediate threat? No. So, Dani, you can go back to sleep. But what did cause a lot of concern was the fact that there was this time period where no one really knew what this Republican was talking about, and everyone was concerned that this was potentially imminent. But obviously, potentially we'll get more details as he will be briefing those lawmakers today.
I don't know, I probably still won't be able to sleep, but thank you for trying anyway. Anne-Marie Hordern, thank you so much. Amy Wu Silverman of RBC is back with us. Amy, you write, talking about elections is so cringe. I agree with you, Amy, and I wish we could not talk about it, but we have to, because we are in the middle of the swing of things when it comes to this campaign season. Do you adjust your portfolio? Do you buy hedges? Do you do anything to prepare for any potential outcome, or is that folly?
You know, it's if you look to history, the short answer is you really don't. You know, there tends to be some pop. You actually tend to get rallies into elections. But for the most part, elections are something that happen in cycles, but it doesn't really impact the market all that much. However, we do have to consider the tails. And, you know, it has been cringe, I think, for investors to talk about elections. Some have called it staring at the sun. It's just very unappealing. But given that we have this event ahead, I would say the left tail and the right tail right now are actually a Republican or a Democratic sweep. That's what they talk about on the tails. And then obviously the Supreme Court ruling is something that can, again, throw a mine into the field right now.
Here's something I didn't expect to see. You write that financials have been really well behaved during elections, an 88 positive hit ratio, 88% since 1992. Can that still play out, though, when you have simmering and sometimes boiling in the background concerns about regional banks, about NYCB? Is it the same this time?
So it's really interesting. First, I borrowed that statistic from our equity strategist, Lori Calvasina. So the only time since 1992, she notes, where financials didn't do well, go rally into election, was the great financial crisis. Outside that, it's done well. And to me, it's actually a breadth argument, too, because if you're going to have a widening of breadth in the market, you're going to get that from financials. And three, I would say, while New York Bancorp was obviously down a lot, you actually did not see it in KRE volatility. So in fact, the put option prices for KRE remain near historic lows, even with what happened during NY Bancorp, which to me would argue that folks think the systemic risk is off the table.
The Hong Kong stock index at HSI, Amy, it's down 50% from its 2021 peak. Even if I didn't believe in an economic recovery in China, even if I wasn't worried about some of the macro, the geopolitics, again, related to what we're talking about in this election, can I say I should be buying that because it's just sold off so much? It's got to mean revert at some point.
Yeah, so, you know, look, I every time I do my marketing trips to see clients, you know, globally, we talk about the China rebound. And if you'll actually remember, there was a time where the idea of a China rebound, of an Asia rebound, was quite consensus. And then, you know, you kind of get into this, oh, it's uninvestable, what can I do about it? I would say right now the consensus is forming that perhaps we have seen a bottom. You really see that first in the options market. That tends to be the leading indicator, because what people do initially is they just dip their toe in the water. You see that through FXI call buying, through ASHR, through KWEB, through these proxy ETFs, essentially saying, you know, I'm kind of worried that if it has bottomed, I really need to be able to jump into that pool. I want to be able to do that quickly. And so, again, you see that in the bullish option sentiment, which leads everything else.
I was going to say, you've seen some of those really big lottery ticket kind of bets in KWEB. That's, of course, the ETF tracking the China MSCI index. Volume spiked last week to the highest in a year. Does it make sense to go long those YOLO kind of China bets at this point? And can you not be actually long the cash market itself right now, Amy?
Yeah, I think it do make sense. And this goes back to the earlier comment I made about momentum in general, which is, you know, if you think about what the options market is actually paying you to do, it's, you know, in the case like in NVIDIA, for example, it's to sell that upside because it's so expensive. But if you actually back test it, if you actually look at what happens, momentum begets more momentum. And there's obviously a gamma dynamic to that as well. So essentially, if you're worried about that right tail, which the market has repriced to be much more concerning to that left tail, that is what you do to get one toe in the water before you have to jump into the pool.
Amy, what I'm learning here is don't fight the big mo. You can't fight the momentum. Really great to catch up with you this morning. Amy Wu Silverman, thanks for your time. Let's get now some of the sector price action this morning and head over to Bloomberg's Abigail Doolittle. Abby.
So right now, Dani, we're looking at very interesting sector composition. We have the S&P 500 up about 0.3%, but most sectors are higher. In fact, we have a few sectors, about 5, that are higher by about 1%. Real estate up 2.1%. Its best day of the year on positive earnings reports. Utilities, materials, financials, energy, all up solidly. In fact, healthcare up pretty well, too. But to the downside, you have those heavy weighted sectors, tech and communication services, both down. Communication services being dragged down by Google, down about 3% on reports that OpenAI may be creating a search feature. Let's take a look at another sector that is under pressure on the week, underperforming, and that is the S&P 500 retailing index, down 1.6%. The S&P 500 itself down about 0.3%, so really underperforming. This, of course, as we have those weak retailing numbers come out, but Lowe's, AutoZone, Ulta, those are some of the stocks in there. This index really not doing so well this week, Dani.
Abigail, appreciate it. Thank you very much. Now, coming up, we're going to look at the market-moving events that you need to be watching. That's up next in our Trading Diary. This is Bloomberg. Just about 30 minutes into your trading day, small caps outperform, up by more than 1.33%. The Nasdaq down after those Cisco earnings disappoint with 4,000 job cuts. Your S&P little change, but we are back above 5,000. It is a Teflon market, maybe aided by some of the weaker retail sales data. Flip it up, look at bonds. Those are also getting a bid this morning. The bid started when we heard that there was a recession for both the UK and for Japan. You are looking at down about 4 basis points across the curve, belly of the curve 10-year, that outperforms down 4.5. All right, time now for your trading diary. What you need to be watching this week. Fed Governor Chris Waller will be speaking at 1:15 Eastern. Then we're going to be hearing from Atlanta Fed President Raphael Bostic. That happens at 7. Then more earnings will be rolling out. DoorDash, Roku, and Coinbase all report after the close. Friday, San Francisco Fed President Mary Daly will be speaking. And then we're going to get U.S. PPI figures. Will that data, will the Fed speak, shake things up yet again in this resilient market? This was the countdown to the open. This is Bloomberg.